Welcome to the Deep Dive. We're here to distill complex research into the essential knowledge you need, quickly.
That's the goal.
And today, wow, we are tackling a giant NVIDIA corporation, ticker NVDA.
The absolute peak right now, you could say.
Our source material, it's deep financial models, market analysis, competitive intelligence. It all points to this, well, almost unbelievable fact. As of September 20th, 2025, NVIDIA is the world's first $4.3 trillion company.
Yeah, trading around $176.7 a share. Just staggering numbers.
So our mission for you, the listener, isn't just about acknowledging that huge number. It's digging into the real question. Is this valuation actually justified?
Right.
Is NVIDIA locking down its position as the core engine of the whole AI revolution? Or is this price demanding a kind of perfection that's, well, frankly, impossible to keep up?
Yeah, it's probably the biggest valuation debate on the planet right now. We've actually run a pretty comprehensive model on their projected cash flows.
Okay.
And we're going to share the intrinsic value we came up with later. But here's the tease. The margin is razor thin. I mean, the gap between the current market price and what our model suggests, it's barely wider than these two massive, almost existential threats the company is facing.
Which are?
Intense geopolitical tension and the fact that its biggest customers are actively trying to become its biggest competitors. That really tight margin, that's the real story we need to unpack.
Okay, let's definitely do that. Let's dive in. All right, Chapter 1, business analysis. Let's start right there. What is NVIDIA today? Because, a lot of people still think GeForce gaming cards.
Yeah, that's the old picture. I mean, the sources are clear. The pivot has been radical and successful.
So what's driving this $4.3 trillion valuation then?
It's a total transformation. They're not just a component seller anymore. They're a full-stack computing infrastructure company. That graphics segment, the GeForce Foundation, it's still there, but it's totally overshadowed now by the compute and networking segment. That division, get this, it generated 89% of their total revenue in fiscal year 25. 89%.
Wow, 89%. And that's mostly the data center business, right? We're seeing figures like, what, $115.2 billion just from data centers?
Exactly. And that's not just selling, a single GPU chip. It includes their big iron, the Hopper, the new Blackwell GPUs, their Grace CPUs, and crucially, the Mellanox networking stuff they bought.
Right, the Mellanox acquisition. That was, what, about $7 billion? How critical was that?
Oh, hugely critical. It was a key piece for building that full stack control. It meant they didn't just own the compute chips, they owned the plumbing, too.
The plumbing.
Yeah, the high-speed connections, the switches, everything that links thousands of these GPUs together in a massive data center. They control the whole nervous system.
Okay, so they sell the brains in the nervous system.
Yeah.
But the sources keep hammering this point. The real moat, the truly defensible part, isn't the hardware. Hardware gets faster, cheaper, Moore's Law.
Exactly. It's the software layer. It's CUDA.
CUDA, Compute Unified Device Architecture. We hear about it constantly. Launched way back in 2006.
That's the one.
Yeah.
And they've been building it, nurturing it ever since. It creates these enormous switching costs. Think of it like, I don't know, a proprietary language or an operating system just for AI development.
The CUDA flywheel effect. For someone listening who isn't deep in tech, what's the single hardest part of CUDA for a competitor, say AMD or Intel, to copy?
It's the ecosystem. It's 2 decades of optimization, yeah, but it's also the sheer number of people trained on it.
The developers.
Millions of developers, researchers too. All the important AI models, the scientific applications, they're written to speak CUDA. They're optimized for it.
So if Google wants to push their TPUs, or Amazon wants everyone on Trainium,
they can offer cheaper silicon, maybe faster silicon sometimes, but they can't just magically replicate that mature, optimized software world and the army of developers who know it inside out. That's the lock-in. That's why NVIDIA has like 92 to 94% of the data center GPU market.
Which sounds like a near monopoly. I mean, that's incredible market share.
Yeah.
But that kind of dominance breeds its own problems, doesn't it? The sources mention this frenemies threat.
Yeah, that's the perfect word for it. Maybe the biggest irony here. The most serious long-term competitive threat isn't really AMD or Intel, not directly.
It's their own customers.
It's their biggest customers, the hyperscalers. Google with TPUs, Amazon with Trainium and Inferentia, Microsoft pushing their Maya chips hard.
Yeah.
They are pouring billions into developing their own custom AI silicon.
Why? To save money? Or is it control?
Both, probably. But fundamentally, it's to reduce their dependency on NVIDIA, to break that lock-in.
But the barriers to actually competing head-on are still massive, right? You mentioned fabs earlier.
Astronomical. You need, what, $20 billion just for a state-of-the-art chip factory? Plus, you somehow have to replicate that CUDA software ecosystem that took NVIDIA 20 years to build. Well, it's a monumental task, a decade-long project, minimum.
Okay, let's move to Chapter 2, Management Evaluation. If CUDA is the moat, then CEO Jensen Huang is the guy who dug it. That pivot to AI years ago looks genius now. How do the sources evaluate his leadership today?
Well, his visionary status is pretty much cemented, yeah. But the focus now in the analysis is often on crisis management, especially the U.S.-China situation.
How's he handling that?
Pragmatically. The sources note he acknowledges the, quote, larger agendas at play between the countries, but his focus stays laser-sharp on serving the market as best they can within the rules. It's described as, like, high-stakes diplomacy under fire.
Makes sense. But with that kind of long-term vision, is there any risk highlighted that maybe he's too focused on the future, missing current issues, perhaps, internal things?
Doesn't seem to be the main concern in the materials we reviewed. The focus seems to remain squarely on defending and deepening that moat. Look at their capital allocation.
The R&D spending?
Yeah, $8.68 billion in fiscal 24 alone. That's 18.5% of revenue plowed right back into research and development. They're obsessed with staying ahead technologically.
And acquisitions play a role, too.
Absolutely, but strategically. Opportunistic buys that reinforce the stack, like Mellanox for networking, or more recently, Run.ai for about $700 million. That was about adding software layers, orchestration tools, making the whole NVIDIA platform stickier.
Okay, so reinvestment is key. What about returning cash to shareholders? They just announced this huge buyback program.
A massive $60 billion share repurchase authorization. That's a big signal.
What's its signal?
Well, it shows the sheer volume of cash pouring in, first off, but it also suggests they might be running out of internal projects that can generate the kind of insane returns they've been seeing. So the next best thing, buy back shares aggressively to boost EPS.
Especially compared to the dividend, which is tiny, like $0.44 a year.
Yeah, the dividend is almost symbolic at this point. The buyback is the main return method. But you want the ultimate metric, the number that really confirms the power of that CUDA moat and their business quality.
Let me guess. Return on invested capital.
Bingo. The ROIC was 95.41% for the quarter ending July 2025.
95.4%.
Yeah.
Just say that again. 95%.
95%. It's almost unbelievable.
Can you put that in context for listeners?
Yeah.
How does that compare? Is any other large company operating like that?
Very, very few. Maybe none in the S&P 500 at that scale. It means for basically every dollar of capital they put into the business, factories, R&D, whatever, they generate almost a full dollar back in profit every year.
Which screams pricing power.
Huge pricing power.
Yeah.
And operational efficiency. Confirms the quality of the business, the strength of the moat. It's extraordinary, really.
Okay, Chapter 3. Financial analysis. We know the internal engine is incredibly efficient. Let's look at the results the market sees. The growth has been, well, explosive doesn't quite cover it, does it?
No, hypergrowth is the term used, and it fits. The acceleration is stunning. Revenue literally doubled 2 years in a row.
Doubled.
Yep. Up 125.85% in fiscal 24, then up another 114.2% in fiscal 25. That brought them to $130.5 billion in revenue.
And when you push that kind of revenue through a business with a 95% ROIC,
the cash just gushes out. Free cash flow shot past $60 billion. $60.85 billion in FY25, to be exact.
and the margins expanded right along with it.
Oh, yeah. Dramatically. Gross margin hit 75.0% in fiscal 25. 75 cents left from every dollar of sales after paying for the goods.
Incredible.
And that flows down the income statement. Net profit margin on a trailing 12-month basis hit 52.41%.
Over half. More than 50 cents of every dollar in revenue drops to the bottom line as pure profit.
That's the power of the moat, the software lock-in, manifesting in the financials.
And underneath all this, the balance sheet is still solid.
Rock solid, like a fortress. Very low debt-to-equity ratio, about 0.13, and huge liquidity current ratio is 4.44. They have maximum financial flexibility.
Which you definitely need given the global volatility we see.
Absolutely. Which brings us to something the sources call the valuation paradox.
Okay, what's the paradox?
Well, the current price-to-earnings ratio, the PE, is around 50. Maybe 50.3. Now, Wall Street often screams expensive at a PE of 50.
Right, typically that's seen as high.
But here's the thing. Historically, NVIDIA's average PE over the last 5 years was much higher. It was 76.42.
Wait, so even with the stock price going through the roof, it's actually trading at a lower PE multiple than its own recent history. How does that work?
Because the earnings denominator has grown even faster than the price numerator.
Okay.
Their profits have exploded so much so quickly that it's actually brought the valuation multiple down. It reframes the whole debate. It's not just about speculative hope anymore. It's anchored by massive, real, and you could argue sustainable earnings power, at least for now.
Okay, let's shift gears. Part 2. Market reality and risk. Starting with Chapter 4. Market sentiment. We know the financials are incredible. How is Wall Street reacting?
They love it. I mean, sentiment is about as bullish as you can get.
How bullish?
The consensus rating is a strong buy. Something like 86% of analysts covering the stock rate is either strong buy or buy. And the average 12-month price target, around $242.75.
Which implies what kind of upside from here?
Based on the current price, that target suggests about 37% potential upside, at least according to the analyst consensus.
And that bullishness has been fueled by some recent news too, right? Like that Intel deal.
Yeah, that was seen as a masterstroke. Investing $5 billion in a collaboration with Intel, historically a rival.
Why was that so smart?
Because it reinforces the ecosystem dominance. It basically signals that even competitors like Intel realize they need to play within NVIDIA's CUD world to be relevant in AI. It validates the moat.
And there was UK investment too.
Right. £2 billion to boost the UK's AI startup scene. Again, smart move. It helps ensure the next generation of AI companies are built on the NVIDIA platform, securing future demand.
Okay, but you have unanimous bullishness, incredibly positive news flow. Doesn't that create its own kind of risk? Like, expectations are just sky high.
Exactly. It creates what the analysis calls an asymmetric risk profile, meaning when everyone already expects perfection, the upside from another positive surprise is kind of limited. How much better can it get? Right. But the downside, any slight disappointment, maybe an earnings miss that wouldn't even matter for another company, or just some slightly cautious guidance, that could trigger a really outsized negative reaction.
Because the bar is set so incredibly high.
Precisely. Technically, the stock looks healthy, very low short interest, trading above its moving averages, but emotionally, the market is demanding flawless execution quarter after quarter.
Okay, Chapter 5. Ownership structure. Who actually owns this $4.3 trillion behemoth?
Well, it's dominated by institutions. They hold about 68% of the shares. The biggest holders are the usual suspects, the passive index giants. Vanguard has over 9%, BlackRock nearly 8%.
Does that concentration pose any risks?
It does, actually. There's a significant kind of hidden risk the sources call structural index risk.
Structural index risk. Explain that for us.
Because NVIDIA has become so enormous, its market cap means it now makes up a huge chunk of major indices, like 7.2% of the entire S&P 500.
Well, over 7%.
Yeah. So think about what happens if the stock starts to fundamentally decline. For some reason, maybe one of those risks we'll talk about hits.
Okay.
All those passive index funds, the ones that just track the S&P 500, they have to sell NVIDIA shares. Not because they think it's a bad company suddenly, but just to rebalance their portfolios back to the index weighting.
So forced selling.
Exactly. Forced selling that can amplify the downward move, creating more volatility, maybe even a negative feedback loop.
That's a powerful external factor. What about insiders? The execs, the directors, are they buying or selling?
The activity highlighted is pretty consistent selling. CEO Jensen Huang, director Mark Stevens, they've been selling shares, often at or near these all-time highs.
Which usually looks like a red flag, right?
It can be. It's important to note, though, that a lot of these sales are reported as being under 10b5-1 plans.
Okay, remind us what a 10b5-1 plan is.
It's basically a prearranged automatic trading schedule.
Yeah.
The executive sets it up months, maybe even years in advance, specifying when and how many shares to sell.
So it's not necessarily them reacting to some bad news they just got.
Correct. It provides a defense against insider trading accusations. But even if it's pre-scheduled, the fact remains that the people who know the company best are systematically taking significant profits off the table at these valuation levels. It's a reason for caution amidst all the euphoria.
And ownership is concentrated beyond just the index funds.
Yeah, quite highly. The top 25 institutional holders own nearly half the company, 46.43%. So decisions made by just a few large funds could really move the needle on the stock price.
All right, let's bring it all together in Chapter 6, Risk Assessment. Synthesizing the core threats. The SWOT analysis points out huge opportunities. Enterprise AI adoption is still low. Sovereign AI demand, the industrial metaverse, or omniverse, Potential $100 billion markets there.
Huge upside potential, absolutely. But the analysis also flags key weaknesses.
Like relying heavily on TSMC for manufacturing.
Exactly. That single point of failure is significant. And also the concentration of revenue still heavily reliant on that data center segment, around 78%.
Okay, but those feel like operational risks. The sources seem way more concerned about two bigger, almost existential threats.
They are. And the first, the most acute, is geopolitical. It's this dual U.S.-China conflict that really threatens their whole business model.
This is about the potential U.S. tariffs.
That's one side of it, yes. The looming threat of a really punitive tariff, maybe even 100%, on chips from companies that don't manufacture in the U.S. NVIDIA is fabulous. They rely almost entirely on TSMC in Taiwan.
So they're directly exposed. What would a 100% tariff do?
It would be devastating to their cost structure. It would crush those incredible margins we just talked about almost overnight.
And the other side is China's reaction.
Right. Beijing has already banned certain advanced chips and could go further. China is a massive market for NVIDIA, maybe 20–25% of revenue historically. Losing significant access there would be a huge blow.
It feels like they're caught in the middle.
Completely. And if this pressure forces them to, say, build fabs in the U.S. to avoid tariffs, well, there goes the capital-light business model that generates that 95% ROIC. That would mean billions, maybe tens of billions in capital expenditure, fundamentally changing the investment story.
Okay, that's the acute geopolitical threat. What's the second big one?
It's that customer competition threat we touched on earlier, the hyperscalers. Google, Amazon, Microsoft, developing their own custom AI chips.
You see this as truly existential long-term.
The sources frame it that way. Their explicit goal is to reduce and maybe eventually eliminate their dependence on NVIDIA for the most expensive parts of their AI infrastructure. It's a direct assault on NVIDIA's core profit engine.
So geopolitical pressure cooker on one side, biggest customers trying to build alternatives on the other. Plus, you always have general macroeconomic risk, right? A global slowdown.
For sure. If companies pull back on big spending plans, those massive AI data center buildouts could get delayed or scaled back. And that hits NVIDIA right where most of their revenue comes from.
Okay, Chapter 7, Conclusion. Let's try to synthesize this. The bull versus bear case seems incredibly stark here.
It really is. The bull case is almost perfect on paper, isn't it? You've got the CDA moat, which seems almost impenetrable right now. Visionary leadership under Huang, this incredible financial flywheel spitting out cash. And they're riding perhaps the biggest tech wave since the internet AI.
Hard to argue with that. But the bear case.
The bear case zeroes in on the price. The current valuation basically demands flawless execution forever. It leaves zero margin for error. And that's before you factor in these really significant quantifiable risks.
The geopolitical time bomb.
Exactly. The U.S. tariffs, the China bans, that's acute risk. And then the long-term grinding threat from customer competition chipping away at their dominance.
So we teased it at the start. You ran the numbers. An educational discounted cash flow model. What were the key assumptions?
We had to be aggressive to even get close to the current valuation. We projected revenues eventually hitting $400 billion. And we used a discount rate of 13.56%, reflecting the high growth but also the high risk. Okay,
aggressive growth, fairly high discount rate. What intrinsic value did the model spit out?
The model generated an intrinsic value of $170.26 per share.
$170.26. Okay. And the stock, as we said, is trading around 176 cents, is $177.
Exactly. As of our analysis date, around $175.79.
Wait a minute. So even with those aggressive growth assumptions baked in, the model suggests the intrinsic value is actually slightly below where the stock is currently trading.
That's what our educational model indicated, yes.
Right.
It suggests the current market price offers little to no margin of safety. The premium being paid seems to fully price in perfection, without much cushion for those big risks we just detailed.
Which brings us right back to the core question for you, the listener. Does the undeniable strength of that CUDA moat, that ecosystem, justify paying a price that offers basically zero cushion against these major geopolitical and competitive storms that are clearly gathering?
Is the potential reward worth the risk when the margin for error is that thin?
It really feels like the reward is entirely dependent on perfect execution, perfect conditions, in a world that we know is anything but.
That's the tightrope NVIDIA is walking.
And hopefully understanding that dynamic, the power of the CUDA system versus the pressure of geopolitics and competition, that's the real value you can take away from this deep dive.
Understanding the forces at play.
Exactly. So if you found this analysis valuable, if you appreciate this kind of critical look at the market's biggest names, please consider subscribing to Stock Analytics AI.
We're aiming to cover all the key S&P 500 stocks.
And members get priority access to deep dives on the tickers they care about. All the details are in the show notes. A super thanks also gets your request prioritized.
And of course, the necessary disclaimer. This analysis was generated by an AI system purely for educational and informational purposes. It should absolutely not be taken as financial advice.
Please, always do your own research, consider your own circumstances, and maybe consult with a qualified financial advisor before making any investment decisions.